Hello and welcome. We will get started in just a moment. Hello once again, and thank you for joining us for today's webinar. For those of you who may not be familiar with Source Advisors, we have helped CPA firms and their clients maximize specialized federal and state tax incentives for more than 4 decades. We are headquartered in Fort Worth, Texas, where we collaborate with accounting firms throughout the country to bring R&D tax credit, cost segregation, LIFO, 179D, 45L, state and local tax, as well as property tax solutions to their clients. A few housekeeping items before I introduce our presenter today. There will be 4 polling questions throughout the presentation. You will need to answer at least 3 of the polling questions and attend at least 50 minutes of the session as measured by the presentation software to qualify for CPE. CPE certificates will be emailed to you in the next 3 business days. Additionally, please utilize both the chat and Q&A functionality, which are located in the upper right-hand corner throughout the presentation. However, if you have a specific question for the speaker, please make certain to use the Q&A function so that we may answer them at the end of the presentation, with which there should be sufficient time. If not, we will make certain to catch up with you afterwards. Additionally, you can now download the PDF of this presentation now. And finally, I'm happy to introduce our speaker today, Imran Syed. Imran joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years of experience in sustainability and energy efficient buildings and is a registered professional engineer, HERS Rater, and Energy Star partner. Imran holds a master's degree in mechanical engineering from the University of Michigan Dearborn. And with that, I will hand it over to Imran.
Perfect. Thank you, Anne, and welcome everyone to the 1 hour CPE regarding energy incentives. As part of the 1 hour CPE, we'll look into a couple of tax deductions and credits and go over the investment and production tax credits as part of the Inflation Reduction Act. And at the end of the presentation, we'll definitely talk a little bit about the current legislation, the One Big Beautiful Bill, although it's in the draft stage, but how does that impact all of these tax incentives that we have? Let's get started with Section 179D. 179D is a tax deduction for energy efficient commercial and high-rise residential properties. There are 2 verticals under 179D. If I'm a commercial building owner and I am putting in a new construction project, or if it's a major renovation project, the project is eligible for a certain tax deduction. On the other end, if a project or a building is a government-owned building or a non-for-profit, since a government or a non-for-profit entity cannot take the tax deduction, they are allowed to take or allocate the deduction to a design firm. So for 179D, either a commercial for-profit building owner can avail the deduction, or a design firm, architectural, MEP firms, contractors who are responsible for the design, or in some cases, design build firms such as those working on government or non-for-profit projects are eligible for the tax deduction. Here are a few examples of properties, buildings that are eligible for 179D. On the left side, you probably are looking at commercial buildings. Basically, any commercial building, whether it's a warehouse, a manufacturing facility, office buildings, shopping centers, and high-rise residential, meaning 4 stories or higher. All of these are eligible projects for the Section 179D deduction. As for design firms, as I mentioned, government projects are all great candidates for 179D. So are non-for-profit projects starting from 2023. This was one change that happened because of the Inflation Reduction Act, wherein non-for-profit, such as churches or other 501c3 projects, are eligible to allocate the deduction to the design firm. So as I go through the presentation, there's going to be a theme of qualifying criteria and deduction pre-Inflation Reduction Act. And then there are changes that happened because of the IRA, which impacted both the tax incentive and the methodology or the qualifying criteria. So let's start with 179D pre-IRA, which applies to buildings that are placed in service prior to 2023. The deduction used to be $1.80 per square foot. That was the total deduction that a project could be eligible for. But it had the ability to partially qualify each of these systems, whether it's the lighting system or the building HVAC, which is your heating and cooling, or your building envelope, your roof, your wall, your window components of the building. All of these three systems were eligible to qualify for a 60 cents per square foot deduction. So you had a chance of either fully qualifying a property for $1.80 per square foot or 60 cents per square foot for each of these systems. Now, one thing to remember as we go through this is for commercial building owners, they can go back as far as '06 in order to take a 179D deduction. And they can file a Form 3115, do not have to amend their returns in order to take the deduction. As for design firms, there is that 3-year statute of limitation, and therefore the last 3 open tax years are projects that design firms can look into. Now, as we went through the Inflation Reduction Act, and it's been a couple of years already with the IRA regulations, major changes occurred both for 179D and 45L. But for 179D, the whole deduction that was maxed out at $1.80 was increased to up to $5 per square foot, and that does not include the inflation adjustment. So basically, the deduction definitely went up, but at what cost, right? What exactly are the qualifying criteria? A couple of changes with regards to that. The building, at a minimum, has to be 25% more efficient than a baseline standard, a reference building in a way. And at 25% savings, that project is eligible for $2.50 per square foot. At 50% savings, that would be about $5 per square foot. And then there's obviously a scale between 25 to 50%, where as the percentage of savings increases, that deduction amount increases as well. But that's the maximum deduction. There is a base deduction, which is 50 cents to $1 per square foot. And for folks who are familiar with the Inflation Reduction Act, there was this theme of a base incentive, and then there's a bonus incentive if a project meets the prevailing wage and the apprenticeship requirements, PWA requirements, as we call it. That basically impacts what deduction you're getting. So if a project does not meet the PWA requirements, that deduction would be 50 cents to $1 per square foot. If the project meets prevailing wage and apprenticeship requirements, that deduction multiplies by 5, and that would be $2.50 to $5 per square foot. So just to recap, there's a base deduction range of 50 cents to $1, but there's also a $2.50 to $5 per square foot deduction if PWA requirements are met. There is one window of opportunity where if a project started construction prior to the 29th of January 2023, right, 1/29/2023, if construction began before that date, prevailing wage and apprenticeship requirements are exempt. You don't have to meet them, and you will still qualify for that higher deduction range of 250 to 5. So as you go into these regulations and you look at clients who have projects placed in service in 23, 24, or 25 for that matter, a question to be asked is, did the construction begin before the 29th of January? And in which case, you might be eligible for the higher deduction range. Here's a summary, basically, of what we just discussed. It's a good one pager to have. Talks about the qualifying criteria under the old rules and the deduction range. And then, obviously, with the Post Inflation Reduction Act, there is a change in the qualifying criteria, but also the deduction amount. One major change that occurred because of the Inflation Reduction Act is starting from 2023, not just government building owners, but non for profit building owners are able to allocate the deduction back to the design firm as well. So that's definitely helped a lot of the architectural MEP firms in expanding some of the projects that they were eligible for. And just to recap, this applies for new construction, applies for major renovations, for both commercial and high rise residential buildings, which are 4 stories or higher. As for design firms that want to take the 179D deduction on their government or non-for-profit projects, there's a process to it. The first thing is to make sure that they're eligible, which is as long as they are responsible for creating the technical specifications, creating the drawings or cut sheets and the specification books, they are eligible as a design firm to take the 179D deduction. If you are merely installing, such as a general contractor or a subcontractor, those firms won't be eligible to take the 179D deduction. However, if it's a design build contractor or a design assist contractor, they can absolutely go after the 179D deduction. Another thing to remember as we go into the next slide is with projects where there are multiple design firms, the IRS does allow that the deduction can be split among multiple firms. All right, that takes us to the first polling question.
The following systems qualify for 179D: interior lighting, HVAC, building envelope, or all of the above.
Yeah, in order to qualify for 179D, these are the 3 systems that are looked into. Solar, as efficient as it is, won't be part of 179D. They may have their own tax incentives, but won't be part of Section 179D.
Just a reminder, you need to respond to 3 of 4 polling questions today and attend for 50 minutes in order to be eligible for CPE credit. I think we can move forward.
Sure. Yeah. Just another reminder, as and when you have questions about the presentation, please do put that in the Q&A tab. Anne and I will definitely address that before the end of the presentation. Just a few case studies before we go into Section 45L. Here's a high-rise residential property. This was under the old regulations, Pre-Inflation Reduction Act. The project didn't qualify for 50% savings. However, because we had the ability to qualify each of the systems, the HVAC qualified for 60 cents, then the lighting system qualified for an additional 60 cents. That's $1.20 per square foot for an 800,000 square foot building. So that's close to $960,000 in tax deduction for a project of this size. Similarly, with a government project, and this was a school, I believe, wherein it's a small project, it's 19,000 square foot. However, the project began construction prior to the 2023 date. So the beginning of construction exemption applied. Project was placed in service in 2023, achieved about 54% savings, and therefore that's about $5.36, which is the inflation adjustment for 2023, resulting in about $101,000 in tax deduction. Another example of another large public school, 110,000 square foot, did not get the 50% savings, fell short by 8 points. However, with that 42% savings, that still gets them a deduction of $4.50, 57 cents. So that's about a $500,000 in deduction for a design firm for one project. So clearly, there's a lot of value in taking these 179D deductions. Here's generally what that process looks like. With a 179D study, it is required that the certification be signed by a licensed professional engineer, and that engineer has to be licensed in that specific jurisdiction or state. And so, therefore, it's one of those things where there's a process to the certification, but there's also requirements of who can sign off on the 179D study. Generally, the process basically is as follows: the commercial building owner or the design firm shares their architectural and engineering plans or permit set. That's reviewed, evaluated, one for checking if it's eligible, and if it is, what could that range in deduction be. Following which, if it's a commercial building owner, that's a straightforward one. The building owner would look at the benefit and allow us to proceed with the study. With regards to a design firm, however, the allocation letter has to be signed by the government entity. So that step is critical in continuing with the 179D certification. And therefore, before going on with the energy calculations and scheduling a site inspection, we do want the allocation letter to be signed by government entities. A lot of the firms tend to bring this up around the end of the construction, which is completely fine. There are some firms that might put that as part of their contract, that the government entity or the non-for-profit entity would sign off on the letter, which is acceptable as well. But one thing to remember is this is the most critical piece for a design firm, is to get that allocation letter. Once we get that, we proceed with the certification, the energy modeling. A site inspection is required in order to confirm and verify if all of the energy efficient components have been installed. And then there's going to be a final certification report along with the form 7205. That's all that CPA firms would need in order to file for the tax returns. Right. Polling question number 2.
Which building does not qualify for 179D commercial building tax deduction? A, auto dealership. B, public school. C, single family home. D, none of the above.
Yeah, as I mentioned earlier, 179D applies for all commercial buildings and all high-rise residential. So residential properties do have to be 4 stories or higher in order to be eligible for 179D.
I think we're good to move forward.
All right, perfect. Okay. All right. So the correct answer is single family homes. Single family homes are not eligible for 179D because they fall below that 4-story limitation for residential properties. However, residential buildings are eligible for what's called Section 45L tax credit. Unlike 179D, this is a tax credit, and therefore it's a dollar for dollar offset against taxes owed. 45L applies to residential builders and developers. Unlike 179D, where there's a chance for design firms to take it, 45L only applies to builders and developers, and there's 2 requirements that have to be met as far as eligibility. Number 1, the entity has to have bases during construction. There must be the owners while the construction is happening. Secondly, they do have to lease or sell these units individually in order to take the tax credit. There are quite a few times where a builder might start a multifamily project, and around the end of the construction, they might end up selling the entire property off to another legal entity before leasing or renting these units out. In that case, the entity that built the project, although they had ownership during construction, won't be eligible to take the credit because they did not sell or lease these units individually to homeowners. So that's a requirement that has to be met. 45L credit prior to the Inflation Reduction Act was $2,000 for every dwelling unit. And for the tax form, that's Form 8908, that has to be filled in order to take the tax credit. It was, a fairly easy way to qualify single family and multifamily projects under the old regulations. Here are some projects that are eligible for 45L. Again, as we talk about it, all single family, multifamily are eligible. In addition to that, apartment buildings, affordable housing project, all of these are good candidates for 45L. Uh, Here's a one-page summary of the changes in both the qualifying criteria and the credit, pre-IRA and post. And I was mentioning in the earlier slide, it was a far more easier way to qualify for 45L credit under the old rules. All that we had to do was show 50% savings compared to the 2006 standard, and that would get them the $2,000 per unit. So energy modeling was required, and there was a requirement to perform blower door and duct leakage, certain inspections that had to be done before the certification is completed. Now, starting from 2023, this was again because of the Inflation Reduction Act, that qualifying criteria was changed to Energy Star. So, for homes leased or sold starting from January 1st, 2023, if a building is not Energy Star certified, the building does not qualify for the tax credit. And the only way to certify a building for Energy Star is if energy consultants like us are involved during the design phase. There are certain timelines that have to be met with Energy Star certification, which basically requires a lot of checklists that have to be completed prior to vertical construction starting, or at a minimum before the drywall goes into whether it's a single family or a multi-family project. There are certain inspections that have to be done before the drywall goes in. And so starting from 2023, if a client asks about doing a 45L study on a project that's already been completed, or the drywall's already in and right in the middle of construction, they would like us to go back and look at 45L, that probably would not be possible. There's no way for us to certify such projects. And that is the reason why, with the new rules, there's been a lot of focus on projects that are still not live yet, but are probably in the design phase, because that's the timing where we as consultants are able to help them out with one, making sure that the design of the project is in compliance with Energy Star or the Zero Energy certification, or at a minimum, start some of these documentation and inspections before the drywall goes in. So timing does matter a lot. Uh, what happened to the credit here? So $2,000 went up to $2,500 for Energy Star, $5,000 for the Zero Energy Ready Home certification. So you can take either one of them, but you can't obviously combine both tax credits. Um, with the Zero Energy Ready Home certification, Energy Star is a prerequisite. So if you want to do zero energy and get that $5,000 per unit credit, Energy Star certification has to be completed. Now, you probably are looking at the credits and see an or a 500 or a 2,500, 1,000 or 5,000. The simple answer to this is, for single family builders, whether these are single family homes, tract homes, townhomes, duplexes, anything where units are adjacent to each other, the project is eligible for $2,500 or $5,000. For multifamily projects, however, prevailing wages would be required in order to get the higher tax credit. If they are not meeting prevailing wages, they are limited to $500 for Energy Star, $1,000 for the zero energy certification. So that 500 to 1,000 only applies for multi-family projects that do not comply with prevailing wages. This is just again, making my point about the reasons why we as energy consultants need to be involved as early as the design phases, because there's a lot of design and construction implications, both because of Energy Star and Zero Energy Ready. And quite honestly, those design requirements vary for each climate zone. So requirements in the state of Washington is completely different than Wisconsin or Massachusetts. So that's one of the reasons why there needs to be a little bit of an engineering study before a project starts construction. I spoke about the zero energy certification and the fact that that can get you either $1,000 or a $5,000 per unit tax credit. And the question does come up of what exactly does that mean? Am I required to install solar panels? Is this going to be too difficult compared to the Energy Star? Now, there is definitely a little bit of complexity with Zero Energy Ready compared to Energy Star. Energy Star is definitely a little more straightforward. Zero Ready requires a few additional things. One of them is the fact that the project does need to be solar ready. Does not need panels, it just need provisions within the building for a future solar panel system. So that would be one of the requirements. Another requirement is for EV chargers or EV charger ready. So that's one of the new things that have come up. And there's a few additional requirements with regards to your mechanical system. I understand this is a CPE for tax purposes, but there are certain engineering impacts, such as the duct system. The zero energy ready system or certification does not allow for ducts to be in the attic space. So, in order for us to help with that situation, there are certain ways of making sure that the ductwork from the mechanical system is still within the condition space. So, this is again one example of how, as a consulting firm, it is almost critical that we help out builders with making sure that they are compliant with the certification. And again, these are things, the reason why I bring these up is these are things that cannot be revised or changed once the construction begins. That's the first thing. And secondly, there's a lot of tax credits involved in this. So if we miss out on even one step throughout this process, it does put the credit at risk. Good planning is definitely a necessity here. Here's just another diagram of how you can make a building PV ready or solar ready instead of actually putting in solar panels. Just about a conduit and a wire that has to go from the panel up to the roof, and you can just stub that out. And then there has to be, a dedicated space for a solar system within that panel board. So there needs to be a circuit breaker that is dedicated for that. And another addition would be a conduit and wire towards where a future inverter system would come up. I do see a few questions, and I will definitely cover this as I go into the polling question. Here's a pictorial representation of what qualifies pre-inflation reduction act and what qualifies after. Again, the major difference being no limitation on the number of stories for residential anymore starting from 2023, and therefore if it's a high-rise residential building, 4 stories or higher, they're eligible for 45L tax credit starting from 23, as well as the 179D tax deduction. So they're able to take both the tax deduction and the tax credit on a high-rise residential property. All right, let's go to polling question number 3.
Starting from 2023, 45L residential tax study requires the following certification: LEED for commercial interiors, Energy Star single family or Energy Star multifamily new construction, passive house certification, or none of the above.
Again, lead and passive house certification and NGBS, these are great certifications, but for 45L tax credit purposes, has to be Energy Star. All right. As we wait for the responses to come in, I do want to answer a couple of questions that have come up. There's one question about a government agency. If a building has already been built and placed in service, is it too late for the design firm to go back for 179D? Not at all. Every 179D study for a design firm pretty much happens after the building is placed in service. And quite honestly, it is a requirement that the building be placed in service, by which we can go in and do a site inspection and make sure that we've verified all of the energy efficient components. So the study has to happen after the building has been completed. What is required, however, is the hope that no one has actually gone after the allocation letter. So um, the study can be done after the project's been completed, but two things to remember. One, uh, do we want to go after the allocation letter right away, or do we want to split that allocation letter or the deduction with other firms? So that would be required. Number two would be for a design firm, they do have that 3-year statute of limitation. So as long as a project is placed in service within that 3-year statute of limitation, it's still open for the 179D deduction, and you can absolutely go back and take it. Another question: if solar panels are installed by builders on residential units, the credit is subject to 45L credit. So solar panels by themselves are not going to help with Energy Star certification. Energy Star does not mandate solar panels. Zero Energy does not mandate solar panels either. But if you are installing it, that's perfect. You're doing above and beyond what is required. However, solar panels by themselves also are eligible for an additional tax credit, and this was definitely not planned, but that's the next topic that we'll be going into, is tax credits for solar panels. But if a builder is already installing solar panels, it surely will help with the zero energy certification, but there's a tax credit for the panel itself. But just want to reiterate, solar panel installation is not required for the 45L tax credit. Right. Just a few case studies before we go into the investment and production tax credits. Here's a residential property, multifamily, 200 apartment units, qualified under the old regulations, and therefore no Energy Star, no prevailing wages, none of that. All that we had to do was prove that it was 50% more or better than the 2006 code, and then obviously do some inspections. Um, that resulted in $2,000 per unit tax credit, a total of $400,000. For multifamily projects, here's basically a takeaway from this slide. 2023, 24 might not be good candidates, because if they didn't do Energy Star, they're not going to qualify. However, if the 2022 tax year, which I believe it is still within that 3-year statute of limitation, you absolutely can go back and look at projects finished in 22, and in some cases 21 as well, and qualify the project for Section 45L under the old rules. For newer projects, you can technically retroactively go back, but Energy Star certification does not allow you to do so. Here's another example of a single family builder, 20 homes within a subdivision. Um, we started this process of getting them to comply with zero ready right after the Inflation Reduction Act started. So we were able to help them with the design and the inspections, and that resulted in about $100,000 in tax credit. That's basically $5,000 per unit. Another project, multifamily, if just to recap, for multifamily builders, you are required to pay prevailing wages in order to get that $2,500 or $5,000 tax credit. When you look into that $500 for Energy Star, it really might not be great of an incentive, and most times that $500 tax credit is not enough for some of the expenses with regards to adding certain construction elements to the project. However, if you are working with a multifamily builder who's probably within that affordable housing industry, probably a HUD or a light tech project, they are required to do prevailing wage, and that this is a really good example of that. Here's a builder who had to pay prevailing wages because they were getting some HUD financing. Secondly, they were required as part of their housing authority to be certified, not Energy Stars certified, but had to be green building certification. And so we went with the Energy Star certification just because one, it complies with their housing authority requirements, and two, they were already paying prevailing wages, which absolutely made sense for them to go after that $5,000 per unit tax rate. So again, this is one of those really great examples of all of the things falling into place with prevailing wages, them needing some form of certification, and Energy Star getting them that tax credit as well. So again, a really good project to go after. All right. One last question before I go into the ITC and PTC and some of the monetizing options under the Inflation Reduction Act. The question is, manufactured and factory built housing, do they need to do prevailing wages to qualify? So for 45L purposes, there are certain different requirements for manufactured homes. Now, if it's modular homes, that's a different segment. But for manufactured homes, that facility that you are basically building your homes has to be an Energy Star certified facility. We as a certifier cannot do much. The factory has to be certified, and there are requirements with regards to prevailing wages as well. Yeah. I don't know how many of you are familiar, have heard about the investment tax credits, but an easy way to remember is the solar tax credits. It's a very popular one. I know EV charger tax credits have been there as well, but solar is where most companies have gone after. Combined heat and power is another system that qualifies for this, but the reason they became more popular under the Inflation Reduction Act is because of the fact that there are options to monetize these tax credit, either by transferability, which is selling these tax credits in a marketplace, or for the first time ever, non-for-profits or other state and local government organizations have been given an opportunity to use direct or elective pay in order to basically monetize some of these credits. A good example is a school district installing solar panels on their buildings. That school district may be eligible for at a minimum 30% of the cost of the project coming back as a check from the federal government, and therefore there's some amazing incentives, and there's some great monetizing options out there. My goal, again, we're short of time already, but my goal is not to go after every tax credit and explain each one of them. I'll touch upon a few of those, but this presentation definitely provides information about each of these tax credits, and if you ever come across something that might fit the bill, absolutely look into these investment and production tax credits. I'll go over section 48. Again, this is a more easier one. Solar, geothermal, fuel cells, combined heat and power, wind, all of these are eligible tax or technologies under this tax credit. The tax credit is 30% if PWA requirements are met. It's 6% if PWA requirements are not met. However, again, with all of these incentives, there's always this window of opportunity. And for Section 48, one of the things that really help clients get the 30% is if the output capacity of the eligible technology is less than a megawatt. If it's less than 1 megawatt output capacity, prevailing wage and apprenticeship requirements are not something that needs to be met. You are eligible to go after the 30% tax credit right away. So again, there's always these caveats, there's these exemptions that you can use to get the higher tax credit. Now, 48 does transition into 48E, making it a little more complicated. Solar and battery technologies can still qualify the exact same way as Section 48. Nothing changes for them. Every other technology, there is a requirement that the net zero greenhouse gas emissions be calculated for the facility itself. So, an example I generally use is if you're putting in a geothermal system, under the old rules, you could just look at the geothermal cost, apply that 30% or the bonus tax credits, and take the credit. Under the new rules, starting from 2025, sure, it's an eligible technology, but you also do have to prove that facilities do have a net zero greenhouse gas emission, and therefore there are some additional calculations that have to be done. I mentioned bonus credits. What exactly does that mean? You already have a 30%. Isn't that the bonus? That definitely is the higher tax credit, but there's a few additional bonuses that are available. There's one which could be up to 10% more for domestic content. So 30% could be 40% if domestic content requirements are met, an additional 10% if the project is within an energy community, census tract or low income community. These areas also do have an additional 10%. So I've seen projects range from 30 to 50% in tax credits. So definitely, there's a little bit of a nuance, and there's a little bit of complexity in one, eligible technologies, and two, how do you maximize getting these credits. Again, with any tax credit, having these discussions early on before construction starts is always helpful in maximizing the credit. Section 45, which is this is basically a counterpart to Section 48. 48 is an investment tax credit. Me as a commercial building owner has installed solar panels. I get to take the tax credit for the first year, which could be 30% of the cost of the project. Production, on the other hand, is basically I am generating electricity from these eligible technologies. I'm selling that or using it. Um, and based on every kilowatt hour of electricity generated, there is a tax credit, and that could be anywhere from zero point 0.3 cents to 1.5 cents for each kilowatt hour. This again is on an annual recurring basis until obviously there's some, it does phase out, but it does help because of the fact that you're actually producing electricity. Yeah, so there's a question about, is that because of low income getting a higher percentage? I guess the question is, are we getting 10% bonus because of low income? It's not specifically low income. However, there is a website from the Department of Energy wherein if you put in the zip code, either it's because of a census tract, or either it fits because of a low income area, or a coal mine closed at a certain point of time. So you've got these varying reasons behind a location qualifying as an energy community, and as long as you put that zip code in there, you should be able to find out very easily whether it is eligible for a 10% additional bonus credit or not. Yeah. All right, let's move on. Advanced manufacturing, I do want to touch upon this before I go into prevailing wage and apprenticeship. This again, is something that a lot of our clients do ask about. You've got clients who are in the business of manufacturing certain eligible components. If anything here helps, do let us know. But solar, wind, battery technologies, critical minerals, if your clients are in the business of manufacturing them, the 45X tax credit allows them to take a credit for each unit of the eligible technology. So, as an example, that unit for a PV or a solar cell could be based on wattage. For a battery cell, it's based on the kilowatt hour. And then for critical minerals, it's based on the cost of that production or manufacturing of the critical mineral. So, 45X, again, it's an amazing tax credit used by entities that are manufacturing here in the US. And if you look into prevailing wage and apprenticeship, as well as the fact that there's a 10% domestic content requirement, that whole thing fits into the 45X, because this again is a way to encourage uh, manufacturers to manufacture eligible technologies within the US. uh, Monetizing options under the IRA. This again, to my point, this is the reason why ITCs and PTCs have really become more popular. I've talked about transferability, where a tax-paying entity can definitely sell those tax rates. They can either use that against their taxable income, or they can use a marketplace to find a buyer and sell that tax rate. I have seen anywhere from 89 cents to 93 cents to a dollar when they sell the tax credits. On the other hand, states and political subdivisions, tax exempt organizations, um, Indian tribal governments, all of these non for profit entities can use the elective pay option, Section 6417, to basically apply for the 30% or more, or 6%, depending on various factors, and get a check or a refund back from the federal government. And when I say apply, what I mean by that is the elective pay option does have this step where a pre-filing registration needs to be done. If a client, and I'm going to use a school district as an example, has a solar and the geothermal system within their properties, both of them being eligible, each of this system would require its own pre-filing registration number, or a registration number, to take care of the elective pay. That generally, and the IRS basically says, as long as it's before 120 days before the tax filing deadline, we should be able to get that registration number. But our recommendation is that the non-for-profits do start that process pretty much as soon as the project gets completed. If a project gets completed this month, start that registration process. So at a minimum, it's already logged in. The IRS has already looked at what you're applying for and what that potential credit could be. And once they provide you that registration number, that's all you do, until that tax filing deadline comes upon us. And then, as soon as that happens, I've seen 90 days to 120 days after tax filing or tax return filing, uh, for them to get that refund check back from the federal government. All right. Polling question number 4.
Starting from 2023, the following entity or entities are eligible for the elective pay option: public school, tax exempt building of worship, nonprofit hospital, or all of the above.
Yeah. As we go through this, just a few more questions I'd like to respond to. There's a question about mobile home parks, manufactured homes, I guess is the point there. Who gets to take the credit? The credit for manufactured homes is basically generally taken by the entity that is manufacturing these homes. The only exception is uh, if I am installing these homes and I am not the manufacturer, but I'm actually giving a contract to a manufactured home to do it, not just buying it, but actually giving a contract with regards to the number of homes that have to be constructed, I get to take the credit. But generally speaking, most manufactured homes, these large manufactured companies that are out there, tend to take the tax credit for themselves. All right. How are we doing with the polling question? Are we almost done?
Yes, we are finished.
Perfect. Okay, awesome. All right. We've got 10 more minutes. I want to quickly go after the PWA requirements. And then if I have another minute or two, go over some of the new um, legislation. I know it's still a draft, but how does that impact the investment and the production tax credits and Section 45L? Um, but prevailing wage and apprenticeship, you've probably heard me say this over and over throughout this presentation. What exactly are we required to do? Prevailing wages is nothing but the Davis-Bacon wages. This is something that the Department of Labor has provided for each county, an hourly rate and a fringe rate for most, if not all, of the construction classification. So folks, if any of you haven't seen what that looks like, it's on the sam.gov website, and it basically tells us here's what a carpenter needs to be paid, or a framer, or a plumber. With these tax incentives, two things have to be met. One, everyone employed on a project, whether it's the contractor or the subcontractor, are making sure that prevailing wages are being met. That's number one. Number two, documentation has to be kept. You have to have sufficient records in order to be in compliance with prevailing wages. Um, Apprenticeship requirements, on the other hand, basically says 15% of the total labor hours on a project has to be, or have to be, performed by qualified apprentices. So this is where a lot of the contractors and subcontractors have to plan accordingly to make sure, one, are we able to find qualified apprentices in our area, and two, based on the number of apprentices they hire, there's a ratio of apprenticeship to foremen that have to be in compliance with as well. But overall, if I'm working on a project, and I'm just, this is just an example, 1,000 hours have been spent on a project overall, at least 150 hours on that project should have been done by qualified apprentices. There is one exemption, I think it's called the good faith exemption, which basically says, if I'm a contractor and I send an email out to apprenticeship program nearby, and I don't hear back for 4 or 5 days, I think 5 business days, if there's no response, or if there's a negative response of them not having any qualified apprentices, I could use that as the good faith exemption and go ahead and take the higher tax incentive without having to meet apprenticeship requirements. However, do remember, prevailing wages will still be required. We talk about documentation. A question that comes up is, what exactly do we do with documentation? Is it just a letter from the contractor basically saying we are meeting prevailing wages? Sure, that could be one thing, but as far as the IRS is concerned, there are certain guidance that have been provided, which talks about using a WH 347 form, a Department of Labor form that tells us exactly how many hours were done by each employee. There are softwares out there that do certified payrolls. Again, certified payroll is not a requirement, but again, if you're doing that and you're looking at prevailing wage compliance, it definitely helps a lot as well. So you do have various solutions out there to provide documentation for prevailing wages. Um, just to cap that off, there is always the beginning of construction exemption. 1/29/2023, which is the date before which, if construction begins, or before that date, if 5% of the costs of the projects were incurred, that project will be eligible for the higher tax deduction in case of 179D, tax credit in case of the investment and production tax credits. All of that would still be eligible for the higher tax incentive without having to meet the PWA requirements. So please do look into that beginning of construction exemption. All right, finally, and I'm happy to go over this with you, but this is quite early to speculate, and things will probably change, but I still wanted to at least give you an update of where things stand as of today. 45L tax credit under the One Big Beautiful Bill, that draft legislation basically is allowing 45L to expire expire by the end of this year, 2025, unless project started construction before the 12th of May. 12th of May is the day when they release this draft. And so they're using that date as a cutoff date. If construction began before that date, then you have until the end of 26 to qualify. But if projects are starting now, this month, they have to be finished by 25. Again, that's just the draft legislation. There's always a good chance, and there's various efforts being done by organizations to extend 45L or bring them back to the IRA regulations, which was expiring it at 2032. So always a chance it goes back to the IRA regulations. But as of today, this is where we stand. Uh, Thankfully, no mention of 179D in this draft legislation, which basically makes sense because it was always a part of the permanent part of the tax code. So no changes to 179D. 179D probably is going to continue. I would have liked the PWA requirements to have been addressed and hopefully eliminated, but clearly that did not happen, or didn't happen yet. Who knows? Things might change. 48, 45, all that changed mainly is the fact that instead of 2032 being the cutoff date or phasing out date, they've reduced that to 2029. So there is that phase out date has changed, but it still gives us good 4 or 5 years before that phase out begins. The good news is elective pay is not mentioned, which means non-for-profit and government entities can absolutely still go after that elective pay option. There are certain limitations on the transferability, but again, we'll see where the final legislation stands out, compared to the draft. And as and when we get more updates, we'll definitely share that with you with regards to the new legislation. Yeah. We've got 3 minutes. I think we've finished with all of the polling questions. I do have a couple of questions here. I do want to address that. What's the difference between a natural gas hot water boiler and a natural gas heat pump water heater for residential energy credit? Good question. With regards to, and I don't want to go into the technology part of it, but with regards to the tax credit, um, heat pump hot water heaters seem to be more favorable. Nothing wrong with natural gas water heaters, but they have to be quite efficient. One kind of water heater that is absolutely not helping with Energy Star or the Zero Energy Ready certification are the electric only hot water heaters. Electric only hot water heaters are basically something that's disqualifying a project under the new rules. Which category does a gas tankless hot water heater fall in for residential energy credit? I'm not sure about what this is regarding, but a gas tankless hot water heater for residential purposes, Section 45L tax credit can definitely take advantage of a gas tankless hot water heater. If it's a high rise residential building, that same technology is helpful in getting the 179D deduction. So it's not so much about the system, rather, is this a high rise or a low rise residential, and what kind of certifications are we going after? Right. But anyways, thank you all for joining. Please do send us your questions. We'll respond as soon as we get them. As Anne mentioned, that the slides are available for you to save as well. And let us know if you have any questions regarding the slides as well. Thank you so much.